Hey, today our role up here is to talk about dollars and cents. We've heard some incredible stories, and I'm lucky enough to be involved with the Green Building Council now for many years, about the benefits to people, about the benefits to our environment. But what we're seeing now is the benefits to the bottom line. And while a lot of focus can sometimes go into the increased cost that may be related with achieving green rated tools or green ratings, not a lot of effort is actually, or not a lot of discussion goes on the value side of things, that whole life cycle of that asset, or the increased value that we get as a property owner, or the increased occupancy that we might have getting tenants to pay a higher rent, or choosing our building over someone else's. So we're going to build on some of those themes today with our panel and really trying to dive a bit deeper to give you some case study examples as to why an investment in green is not only good for people and the environment, but also good for your bottom line. We're also going to touch a little bit on green finance. We're going to dive into the world of green bonds, the availability of finance in the green space, and what the benefits of that are. So before I kick off, I will introduce our panellists today. First up, Dean Spicer. Dean has 25 years experience in the financial markets. He's worked through Europe and is currently head of sustainable finance for ANZ. He played a key role in Argosy's green bond that we all know about, as well as Auckland Council and Mercury Energy, and is also a graduate of Lincoln University with a Bachelor of Commerce and Management. Next to Dean is Peter Mentz. We should all know Peter as CEO of Argosy Property. They've been leaders in this space for some time, and really proud to have Peter up here with us again today. His 40-odd years of experience in the industry here in Auckland is unprecedented, and as CEO of Argosy, leading that transition that they've taken into the green space, we'll get some really practical lessons out of today. And along one more is Kate Archer. Kate is the Associate Director of Sustainable Finance for Westpac. Kate also, prior to Westpac, has experience with GRESB. Probably pronounced it wrong, GRESB, the rating tool that we'll hear more about today, while she was based in Amsterdam. So bringing some of that global experience and rating tools with us, along with the roles she's had at banks such as Bank of America, Merrill Lynch, some of the big corporates overseas. And then finally, last but definitely not least, is Richard Hilder. Richard's the CFO of Precinct Properties. He's held that role for the last 4 years, and there's no secret what Precinct have done to change the skyline of the city in the last few years. Not only the development of Commercial Bay and Wynyard Quarter in Auckland, but the work they've been doing with Bowen Campus down in Wellington. Richard chairs the Precinct Sustainability Committee, which encompasses all elements of ECG, and also comes to us today with the global experience that he's gained working overseas with Goodman in Europe as well. So we've got a bit of a rock star panel here today that will hopefully help convince anyone that needs convincing that green's also about the bottom line and the returns to your investors. So Richard, to kick us off, a bit of a scene setter for the team. We know the benefits. We heard from our panellists prior to us today all of the reasons why this shouldn't even be a discussion. We should just be doing it anyway. But why is it so important to you? Why is it so important to Precinct that we do look at the dollars and cents of the green decisions as well?
Good morning, everyone. The built environment makes up 15 to 20% of all New Zealand emissions, and so that should be reason enough to kind of go on a bit of a green path. At Precinct, we've developed $1.5 billion of new assets in the last few years. We've got 2/3 of the portfolio, but 1.8 billion, which is green, so it's either 5-star, Green Star, or 4-star NABERS in NZ rated. And as part of that, I suppose the awareness of being green has been highlighted, especially around embodied carbon. And so as a business, we have moved forward on that. We've progressed to understanding offsetting of embodied carbon. So we've begun that process for future developments. We've also moved to zero carbon as of last year through the help of Toitū. And look, we want to continue that pathway, and we've just started that journey in terms of funding, so we've greened our existing bonds that are on the NZX market. But who's driving that? It's all our stakeholders. So it's our board of directors. So climate change is a strategic risk for boards, so they have an obligation to understand those risks and mitigate those risks. And we've got a very supportive board at Precinct Properties. In addition to that, the equity and the debt markets over the last few years have become very active in this space. So our banking syndicate, the debt capital markets, they're all asking us. And the equity market, probably once a week, I'll be having a conversation with an institutional investor around what we're doing in this space. And it was interesting this week, NZX just started a new index for carbon low companies, and that shows the shift in capital to kind of green assets. The other two in relation to kind of our customers and also government. So government are making a big push in this space, zero carbon, RMA, building code, embodied carbon through MB, they're looking at that. And also where they want to occupy buildings. In Wellington, they want to have energy efficient 4-star minimum spaces. And look, I think the last point on the last stakeholder is just actually all our occupiers. I can't recall the last time we got an RFP that didn't have a sustainable either benchmark requirement or a response. So, yeah.
Thanks, Richard. I think we'll dive into some of those tools a bit later, but keeping the context for today, maybe passing over to you, Kate, about more of the green finance side of things. What's your role in Westpac and how's green finance playing a role in activating green buildings?
Yeah, sure.
Oh, there is one microphone turned off. You were the lucky winner.
Can you hear me now? Yep. Yeah, so I guess within my role at Westpac, we're talking to customers every week, every day, it seems like, on their sustainability strategy. And when we're discussing what they consider when they're making these financial decisions into sustainability, the financial aspect is obviously always strategically material, but that's not the main point. It's not a matter of foregoing financial returns to achieve better sustainable outcomes. I think you hit it right about the stakeholder point. I think that is driving most of the sustainability actions that we see these days. And looking at the property sector, I think out of all kind of real asset sectors which you could look at, the property sector has some of the greatest evidence and case studies to prove that sustainability has a financial benefit. I mean, we've looked at, and we share with customers often, the Green Building Council of Australia did a great report estimating that the payback period for Green Star certified buildings is 5 years or less. I mean, I'm sure you'll speak to today some of the financial benefits from in terms of operations, reduced, increased tenant demand, interest, productivity. It's all really clear there. And for us, real estate is a long-term asset class. So if you're building new and not considering that, you're at a huge risk as the property sector decarbonises quickly in the future. So that's how we look at it, I guess, from a credit and customer engagement perspective. It's really customers who have a strong focus on sustainability. They just have better management of their own business risks and just better business management overall. And so when I was at GRESB, so GRESB is a sustainability benchmarking tool, which was founded by a whole lot of institutional investors. And because of that institutional investor base, the question was always from investors, is there a financial return if you're investing in a company that has greater sustainability performance? And so they did two strong studies on that. One was with the University of Cambridge, looking at a whole lot of real estate investment trusts. And there was, when they did that analysis, they proved that there was a really strong correlation between that financial performance and greater sustainability scores as assessed by GRESB. They then did another one a few years later, and it proved that correlation again. So I think there's enough studies out there proving that financial point. It's good that the discussion's moved on, and I think that's not what everyone's chasing. The broader benefits, such as stakeholders' engagement, are there, and the property sector has a huge role to play in transitioning that.
Thanks, Kate. Dean, from the ANZ Bank's perspective, in our lead-up, you discussed some policy changes that have led to a big change in this space. Do you want to maybe give some context to that?
Sure, and look, I'd echo Kate's point that a green bond, if you like, or a sustainable financing product isn't really the badge or the prize at the end. It should actually reflect back to the way companies operate, and ultimately banks, if you think about who we are and how we operate, we are conduits for capital, and we need to reflect trends that are happening in markets. So sort of stepping back at a higher level, I think the expectation that we find when we go out to capital markets is there'll be a question around our sustainability strategy, and that should reflect our overall purpose. And whether we're coming back for a capital raise or to update investors on an annual basis, there is a rising bar in terms of expectations of delivering against that strategy. So I guess the key point would be that longer term, we're seeing a rapid change in the marketplace. It's across all stakeholders. It's probably been driven initially from consumers. So the conscious consumers now are alive and well in terms of capital providers generally. And so for us as a bank to access capital, then we have to be able to show that we're actually delivering on our strategy. And I think there's probably a key point there that businesses that don't adapt to this changing environment, I think we'll find access to capital and cost of capital will be an issue longer term. So the policy changes that we put in place are really reflecting what we're seeing as aspirations from companies we're engaging with, as well as from investors who are funding us, and that we are obviously then on funding those businesses. So in particular around buildings, the change that came out last year was bringing in for large-scale office new builds a minimum NABERS 5-star and a Green Star design 5-star rating in Australia, or the equivalent across other countries that we operate in. And that's just reflecting the fact that different countries have different availability of data, so that data point again. But without going on too long, I think the data thing is really, really interesting, and what we're finding from investors is that they are being given a suite of data. They're scraping that data and picking it up from various sources. So a lot of bond investors sit there with Bloomberg terminals. They're starting to look at their ESG scoring of Bloomberg and Sustainalytics and others. So that is giving them a lot of information. They obviously then they'll filter in down on the things that are important for that particular company. I think the data piece is going to continue to grow. So I don't think there's going to be anywhere for anyone to hide. I think there's going to be actually more visibility in terms of delivery against ESG strategy, and ultimately, I think the impact we have as a business is going to be was already been captured and measured and reported. But I think that trend is going to continue to grow.
Yeah, thanks, Dean. Peter, bringing you into the conversation, I guess he's touched on many of these points that are already discussed, whether it's on the built environment, retrospective fit-outs, whether it's green bonds. Do you want to give us a little bit of an insight as to why, as Argosy, you've been leading this conversation? Is it a tenant attraction piece? Is it a life cycle cost? Why have you guys gone so strong on this over the last few years?
Oh, that's interesting. Look, fundamentally, from an Argosy perspective, it really started from that desire to be congruent. What you believe, what you do, need to line up. And if you're doing at work where something that's consistent or congruent with your own belief pattern, then you're going to be happy. So that's really where it started. But what makes it work from a dollars and cents perspective is the same thing, but from a tenant's perspective or an occupier's perspective. So if you can achieve some of those golden things as a business manager, if you can have happy staff, you get better productivity, you get less absenteeism, you get greater resilience right across your business, and your staff retention rates are up there. So if you can achieve all of those things, then you've got the nucleus of what is always going to be a great business, because that's always what we're trying to get to. And tenants are looking to achieve that. Occupiers are looking to achieve that. And the way to achieve that is through green buildings. And if we can provide a better environment for tenants, for occupiers, then they are prepared to pay. It does give us the other end of the cost equation. It gives us the value because we have less vacancy rates, better rental rates, we have happier tenants, and they are creating a great environment for us as a landlord to work more closely with them to reduce the footprint of each asset. And that's a golden thing for a property owner, because the information you need is nearly always on the other side of the table, and the closer you can work with the tenant and the tenant's operation, the better you can create long-term value.
It's good. Richard, coming back to you on the precinct point of view, and sticking with the built environment piece of your portfolio, you've had some initiatives throughout your property portfolio that have shown a green return. Can you give us examples of what they are, please?
Yeah, sure. So Wynyard's a good example of that. We're very active in that space with Panuku. Our most recent development we finished in January, 10 Madden Street, which is leased to Media Design School and Google, and we've put solar on top of that building. It's the first time we've put solar on our commercial buildings. And the plan with that is that it will be used to power common area, and we will charge effectively a market rate and put that back through the OPEX. If we sold that electricity back to the grid, it wouldn't make any sense, but putting it through the OPEX works for both the occupier and for us. And in terms of the numbers, that solar has cost about $140,000, and we expect to generate about $14,000 a year moving forward. So like a pretty good return, we think, on that type of investment. And staying with Wynyard, Panuku and ourselves are very focused on Green Star in that location. And so as we look at the development in the feasibility stage, we assess the incremental costs of moving from 4-star, 5-star to 6-star. And effectively, it's about a 3 to 4% increase in construction costs each time we jump from, say, 4 to 5-star or 5 to 6-star. And to give you a sense of the numbers, our next stage at Wynyard is stage 3. It's 20,000 square metres of commercial office. In total, that will be, to get it to a 6-star, would be an additional $6 to $7 million. And that's probably an increase in your market rents of about $20 to $25 a square metre. So going into that, when you commit to a project, is very helpful and informative, especially when you're talking to pre-commitment clients to get a project underway. And it's much easier to start on a green footing than try and correct it later once you've built the building.
Yeah, I think it's interesting to talk about, potentially increased rent for a tenant, but I guess commercial property is so complex that you've also got to take into account things like your vacancy. So you might actually lease that up faster than a competing building as well, and that's where those dollars and cents do get a bit tougher to measure, don't they?
And I think in Wellington in particular for us, that's huge. 30% of our revenue comes from the government. And with their shift of saying we want to be in new buildings at NABERS NZ5 or existing at 4-star, we have to make sure that that product is fit for purpose in that market. With what we've done in the last several years, we are in a really good position to leverage that. But that is value that will come at the next renewal, and we should benefit from that.
Yeah, I think it's a fantastic move from the government to make that NABERS minimum rating for their tenancies, and it's something that we're seeing a lot of our occupiers follow suit on. Kate, Dean, maybe start with you, Kate. You as Westpac are a big occupier. You're not just here with your green finance hat on, but you guys have got a big office footprint, you've got a big retail footprint around the country. What are you looking for to support that conversation around those tenant demand drivers?
Yeah, I think the buildings we have, we want our staff to go, to the office to do their job and have that, they enjoy working in that space, aligning with, our sustainability commitments. For any new commitments or long-term leases that we enter into with, new large offices, the core metric is having a high energy efficient building, whether it be Green Star or NABERS. So if you look at our Christchurch office, that's 5-star Green Star. Obviously, the one in Britomart, we're really proud, the big, red W up there in an energy efficient building. So that's always been key to us. I think obviously we have a footprint in terms of the buildings which we operate out in, but ultimately our biggest impact is what we are financing. So, you may have seen Westpac's sustainability strategy, which we released a month ago. I encourage you to check it out if you haven't. And that's looking out to 2025. And one of the key commitments or focus areas in that is that we want to develop Paris-aligned financing strategies for high-emitting sectors. So kind of that's taking a step further, going beyond our carbon zero certification that we have and increasing the scope of what we measure and report on when we can get that available data, kind of looking deeper into our supply chain and our lending activities. And so the property sector is obviously a huge part of that. It's a huge source of emissions in New Zealand. So we're having a lot of conversations with our customers around their sustainability strategy, what carbon reduction plans they have in place.
Great. And Dean, ANZ's.
Yes, Lynn, look, I think it's one of the things that will probably coming through with the comment around the government's desire for tenanting green buildings. I think ultimately that demand is only going to grow. So naturally, when you're in a building footprint, you have what your existing footprint is. But I think ultimately that is a key consideration on new buildings that we occupy going forward. But within the existing, I suppose, considerations as to how we try to operate. So one of the things that we're considering is if there's a new fit out for a building that we're going to occupy and one perhaps that we're vacating, then the target is to reuse 70% of that fit out. So that sort of waste to landfill is a key consideration. I agree with Kate. I think the biggest impact we can have is in terms of what we finance. And the supply chain is becoming a bigger and bigger focal point in terms of sustainability generally. So the procurement team has linked up with Akina Foundation New Zealand in terms of their procurement tool that allows consideration to be given to social enterprises, for example. So I think the whole thing about the sustainability strategy is it's broader than just the environmental impact. And I think the impact on the community from a social point of view has become increasingly important. Probably post-COVID, it's got a lot more attention than what it did pre-COVID. So one of the other points I was going to make is I think investor expectation or stakeholder expectation is growing. And perhaps getting off topic a bit from your question, but one of the things we found earlier on was that the market took a while to adapt to sustainable products like green bonds, but very quickly the question moved from what is a green bond to okay, that's great. I think it might have been on one of Argos's roadshows. Well, that's fine. We understand you've got a green building and you're financing this, but tell us about your broader sustainability story. And I think this sector's done a great job at being able to take the market forward. So with Precinct now greening their bonds and Kiwi Property recently as well. So it's sort of really taken our market forward in that respect. The next stage in the development we're seeing starting to come through is companies that don't have green assets, but they can finance through sustainability-linked or ESG-linked funding, bonds alone. So there is an evolution coming, and that overall sustainability strategy is getting a lot of focus.
Let's stay on that topic of green bonds for a bit, and maybe just Peter, for the Argosy bond, $100 million, maybe 2 years ago now. What was your decision-making process to issue a green bond, and how did you go about it from a Argosy perspective?
Oh, that's an interesting story, actually, because it goes back to what I'd said earlier on. With both the green bonds, and obviously the first one was the one that was more pioneering as far as getting the board over the line and everybody else. And that was really born by wanting to finance the business in the way we ran the business, because we run the business the way we want to run, the way we want to be. So that congruity again between the way you fund the business, the way you run the business, that was the reason for it. And with the first bond, there wasn't really any better pricing, I don't think, Dean, because it was green. But with the second bond, potentially you were getting a little bit more demand, not necessarily pricing, but it's starting to grow in that corner of the world. And I think from our perspective, it helps that we can show the Argosy story, why we do what we do, why we think the way we do, and we're being consistent.
Dean, you're involved in that. Where did the demand come from? How did you go about that evolution and taking that to the market?
Yeah, and look, I think in the early days, Peter's right. The conversation was, look, you're not going to get a pricing benefit from that. There was certainly and continues to be a significant diversification benefit. So you'll attract investors who perhaps, may not otherwise have been attracted to the transaction. Increasingly, there's globally there's evidence coming out that there is a pricing benefit, a green premium or a greenium coming through. But I think ultimately the big attraction would say is really around that diversification. So the growing pool of money coming into sustainable financed assets, really driven by the fact that a good example in New Zealand was a survey of KiwiSaver investors, 2/3 who said they wanted their money managed sustainably and ethically, and they would switch to get that. So I think asset managers know that they actually have to deliver a product, if you like, that reflects that demand, and that is attracting a lot of interest in New Zealand and globally into sustainable debt financing. So initially those bonds, it was a mixture of retail, distribution and wholesale. I think the market has evolved, and Auckland Council issued a 30-year, 500 million green bond last year that had quite a bit of international uptake as well. So that was probably a surprise for everyone, because we probably didn't expect the New Zealand market could attract that size and that tenor previously. So how much was that driven around the green aspect and versus other market conditions? It's always hard to be definitive, but what we're finding is that there is definitely an attraction from investors for green and sustainable product.
Yeah, interesting, isn't it? We track the share price of some of these companies announcing their green bonds, seem to get a benefit there as well. Kate, how far can this go? What's in it for the sector? What's there in terms of green financing tools in the future?
How far can it go? It needs to go far. So I think we've got a lot of momentum. I mean, you look at the sustainable debt market globally, and it's huge. It's increasing at pace, the amount of issuances we're seeing. But in reality, New Zealand is smaller than that. I mean, we put it about 10 billion in sustainable debt that's been issued, or sustainable borrowings, and it's from about 10 companies. So it's by no means significant, and we need to accelerate that. The property sector's been a big player in that to date. You've mentioned Argosy Precinct and Kiwi have all developed their sustainable borrowing programs. I think in terms of moving that going forwards, and from a lot of conversations we've had with customers, I think what we'll see as well, and in the future we're going to see more types of property. We've had a lot of focus on office buildings and the Green Star performance of that, but a lot of good stuff's been done in the industrial sector, warehouses. So I think that could be one of the trends we're seeing, that it's having a trickle-down effect, maybe in terms of competitive pressure. We've seen a lot of property companies come forward with these green bonds, so it's really highlighting the fact that what is other property companies doing in this regard. Another aspect I guess I'll touch on, and Dean, you slightly did as well. I mean, we've spoken about green bonds to date, and for those in the audience who don't know what that is, I mean, it's when you're issuing a bond and the proceeds are being allocated towards environmental assets or activities. So it's very proceeds based. What has happened in the market is a lot of companies are realising they needed capital to be able to transition, but they may not have an environmental asset base. So a sustainability-linked instrument was developed in the last few years, really, and it's grown at pace, because every single company, every corporate who should be having a sustainability in place can issue one of these. The way they work is essentially, if it's a link in the pricing, so maybe for a sustainability-linked loan, based on how you achieve your sustainability performance and targets. So I think what we've seen that, for companies who may not have that asset base, we've seen that increase in demand. And the interesting thing, I think, for the broader property and construction sector is that globally it's been these really hard to abate sectors coming forwards with these structures and making commitments. So in the last 6 months, it was, as we see greater focus on embodied carbon and, decarbonising, the construction materials, we've seen a huge amount of cement and, construction materials organisations come forward and link their financing to achievement of targets, sustainability targets. So we're getting all areas of the broader property sector involved in these structures, which I think will be impactful.
You touched on targets, Kate, and just before I pass over to Richard, you've had your experience overseas with GRESB, and maybe this is a way that we can pivot the conversation now. We've talked about the green buildings themselves and the demand for those. We've talked about some of the funding mechanisms that exist. How are we measuring all of this? How does that actually translate to something, data that can make people accountable?
Yeah, the data point is absolutely huge, as I'm sure many of you in the room will know, and we don't want sustainability to become just a reporting exercise and burden. So I think the focus on data and streamlining that with reporting will become more and more important going forwards. At Westpac, we've been confronted by the challenges of that data problem in a numerous number of ways, I guess. So we're wanting to integrate climate risk into our lending decisions. And so one of the first part of that, and we've spent the last 2 years looking at what the risk is to our residential property book and our commercial property book due to coastal hazards, so flooding, erosion, due to potential sea level rise. And getting the data for that was challenging. Lucky our broader team worked with NIWA to get that data, but it was a big exercise, and it wasn't just the getting access to the data, it was actually then being able to interpret that to see when that physical risk is going to have a financial risk and impact. So those assumptions were really critical. And that was a huge piece of work, just understanding where our risk, where it is now. The data challenge again, Westpac New Zealand, we issued a green bond, the first New Zealand bank to do so. We went into the European market, and part of that green bond, we make a commitment to report back to investors on the impact of that. What we've seen globally in Australia is that, so a lot of our green bond proceeds are allocated to the property sector. So as we go about, doing our research, trying to highlight that impact, we are faced with some of the challenges that there's not that data availability and data availability online. If we look at Australia, because they're more advanced maybe in the regulation in the office space of energy efficiency ratings and NABERS rating, that's all readily available, and our teams in Australia can get that information a bit quicker. So that's one of the challenges we faced in that report. And the GRESB aspect, I guess, taking a step back from Westpac as well, and our experience there. So that was an investor-led organisation, and it shows that investors are wanting this data. GRESB started 10 years ago, and the aim was to have a consistent reporting framework so that all companies could report, in the same manner, and it was comparable. Back then it was just a limited number of reporting metrics, and now investors are really driving not just kind of reporting on a whole portfolio level, it's actually wanting that data for individual buildings, and that's highlighting the data challenges and data gaps that are in place. So disclosure of this information is hopefully driving improvements in sustainability. But yeah, it's very much driven from investors in that aspect.
I like GRESB and some of the early introduction I had to it pre-COVID when the team came out to New Zealand and presented, which Andrew arranged through the New Zealand Green Building Council. And since then we've seen the adoption of some businesses, and Precinct is one of those, isn't it, Richard? I think a 83 rating. Can you explain to us what an 83 rating has taken and what other tools you use to be accountable in this space? Yeah, sure. So GRESB, just so everyone is aware, is a global benchmark. So there's about 1,200 companies around the world that do that. It's about $5 trillion of real estate. So it's a really good benchmark to test where you are. Generally, the global average is about 70. We started 3 years ago at 40 out of 100, and we've got that up to 83 over 3 or 4 years. And it's created a great framework for the business to follow around sustainability, around policies, and I guess the biggest learning has come from the likes of the help of Toitū in terms of the certification that feeds into that system. And the certification process, probably the big learning is that New Zealand's quite behind in terms of certification. We compared to Australia or Europe, we don't have the same level of certification from an ongoing operational perspective. We do the Green Star well, but we don't have compared to Australia that has had NABERS for many years. It's at a different level.
And I think even to add on that, I mean, that's a really good point, that we have got a lot of good momentum in getting certain buildings rated, but in the whole focus of GRES really is your overall sustainability performance. So it's not focusing on a few buildings that may be designed new and you can profile that strong rating they have. It's for the overall portfolio. So it's often focusing on, what is the carbon footprint from your top and your worst buildings. And I think that's where we're going to see more focus, not just on highlighting a few good buildings, which is great within portfolios. It's of the entire portfolio stock. And as we're seeing companies setting carbon reduction targets and having more disclosure of their entire footprint, of their entire built portfolio, then that'll become much more impactful, I think.
The other part of GRISBIT has been hugely helpful to us is if you're familiar with the insurance market, they'll often put it through a model to work out seismic risks and things like that. They've got that in GRIS, so they know each location of your buildings, and then they'll send you a report around your resilience and your risks to sea level, to flooding, to fire, to droughts, and all those things. So you get a very clear snapshot around your portfolio. For a governance committee, it's very helpful.
You also mentioned Brave Gen and some other tools. Do you want to give an insight into what they're capturing to help you make these decisions at a governance level?
Yeah, so you're working Twitter and Brave Gen to work with suppliers to get that data. I guess the biggest piece that we've done recently is the offsetting of 40 Bowen campus in Wellington. We worked with Mott MacDonald and Brands to understand what the embodied carbon was of that project, and understandably our buildings are full of steel and concrete and glass, and particularly in Wellington with seismic focus, steel's a big part of that. And we measured that, we've offset that cost. It's quite minimal in terms of the overall budget, and again, it's the right thing to do. But with the help and kind of guidance of those organisations has been hugely helpful to kind of direct us.
Nice. Dean, we've heard a lot of, again, the reasons why. If someone's out here today and they want to get started, how do you start a journey towards this? What's the process involved? Is it a simple process? What commitment does a business need to make to make this reality?
Look, in many cases, most businesses have started on a journey. I think we've sort of talked as a panel about the broader engagement with stakeholders and the sustainability strategies that are in place, and the fact that Richard's heads up his sustainability committee, but also has a CFO role, just shows how well integrated sustainability and finance has become. So, look, I think one of the challenges is that there's actually quite a bit of speed and momentum behind the expectation of general broader stakeholders. Most businesses will understand what those expectations are. I think the key point is that you need to make a start, and so a good place to start is actually looking at where you are in terms of your sustainability strategy, the reporting, the data that's been talked about, because I think, as we said it before, a green bond, for example, isn't really doesn't hang there by itself. There's an expectation that there's broader ambitions around how you run your business and the impact that you're having as a business. So I think that's probably been one of the big changes. I think there's a momentum shift there. So one of the things we haven't touched on, but I'll mention here, is that often the process of going through and actually putting together a sustainable financing framework and issuing these instruments has been the really positive feedback from stakeholders, but particularly internal stakeholders, where it's actually brought together internal teams that perhaps in the past haven't really been that well coordinated, and they realise that actually there is actually a common goal here, and this ties back to that corporate purpose, and I think that's incredibly powerful.
Yeah, well said. Peter, if you could go back to your first steps, and we probably go back many, many years now, you've learned a lot through your journey. What are those lessons you've learned that could benefit others, that could speed up the process or improve the process along your journey?
Oh, it's a good question. Firstly, I think when we first started playing with green buildings, it was really the property team trying to convince the finance team that it was worth going down that path. And it is absolutely fantastic to see finance teams who are now zealots for the cause. So come a long way from that perspective. The first and most important thing is to be comfortable that as a management team, as a board, as a group of stakeholders, that you really want to do this. Because if you really want to do it, it's completely achievable. You have to accept that you will have to do some pioneering, you will have to take some risks. Not all of those initiatives are going to pay off, but it's worth it. You get there and the growth process on the way through is there. I would suggest that if we were starting again, I'd probably be more dogmatic than I was at the beginning. I'd probably have moved Satish into sustainability earlier than I did. And I can see him sitting there, and I'm not going to look because he's going to laugh. I'd probably have taken more risks in getting there.
Yep, you got a nod. Yeah, thank you, Peter. I think there's so many nuggets in your experience and what you've done there. Last question for our panel, and then we're going to go to Slido. So if you do have the app open, feel free to put some questions up there, and we'll go to those in a minute. But Richard, as your role chairing the Sustainability Governance Committee for Precincts, what are the risks? If we're not doing this, if we're not paying attention to the data, if we're not engaging with green finance, we're not using the rating tools, what are the risks?
Yeah, I think we understand the physical risks pretty well. So yeah, sea level rise and higher mean temperatures and more impacts on HVAC and things like that. I think that the transition risks to a low emission economies, that's probably where it is. So you've got to have the right product in the right spaces that meets the demand for what occupiers want. If you don't have that, you're going to have higher vacancy and lower rents. And the other one that's a big risk is, I think, government. So increased disclosure coming for us in particular, more regulation, RMA changes, building code. You've got zero carbon bill. And then there was a submission at the end of last year from where MB sought submission feedback from the industry around development caps. And on emissions. So if you're doing a new build, what are the embodied carbon that you can do on a project? And having building owners adhere to that and also comply with ongoing operational kind of efficiency for energy efficiency for buildings. So I think that's fairly well known by us being listed, and we're quite aware of that, but I'm not too well, not sure how well that's kind of spread through the wider industry.
Kate, do you want to touch on that risk factor from the banking perspective?
Yeah, I mean, the point I wanted to follow on from yours is that you spoke about, TCFD coming and what impact that'll have. As soon as that announcement was made, we had so many customers reaching out to us and asking about it and trying to get their head around it. And I think that is really, that was actually quite a trigger point we saw in accelerating, the TCFD aspect of it, but also it also drove the whole sustainability strategy as well, and considering that. So I think that's a huge positive.
Nice work. So I'm going to cast over to Slido now. We've had 34 likes for a question, so there's been some great engagement, and hopefully you're supporting Andrew's Twitter tag so he can overtake Chelsea. But this question relates to the lending policies, and the question that's been liked 36 times is, will there be lending requirements and policies set in place to ensure developers are using sustainable methods of construction? Dean, I might go to you. You mentioned an ANZ policy around 5-star Green Star for the office sector. What else is in place that can address this?
Yeah, look, it's a good question. I expect that, I might be repeating myself, but I think there's a rising bar in terms of expectations that's happening continually. In fact, the momentum is such that I think it's hard to keep up with. I'm not sure specifically whether it's what policies or regulations will come in to that level of detail. But an example that I've seen out of Europe was an expectation that banks will have to report on a green asset ratio. So, which is sort of a little bit different, but I suppose the point there being that there's going to be incentives and ambition around banks to finance more green assets than not. And I think the point I made earlier about waste, landfill, the component parts of those products that come in, which comes back to the supply chain, all of that ties together. So whether it's actually regulated or not, I don't know, but I do think that the expectation is such that that will be the focal point And it's no longer going to be a matter of simply saying, here's a building. I think the focus from occupiers and funders and everyone else is going to be, okay, tell us more about that building and how was it constructed and what was the waste impact of that build.
I think if I can add to that as well, I think we're also faced with an obvious land shortage in New Zealand, and so much of the land is controlled by both Panuku and Kangaroa. and what we're seeing as being working on their behalf to sell land in these super lots and things, is they're actually now putting huge amounts of obligations onto developers before they're sold. So it's not just the financing sector and that are playing a role here. It's at that point of acquisition now that we've actually got leadership that says, if you are the successful buyer of this land, you must deliver to these standards. And I think that sort of leadership is really setting a good example for those organisations. Peter, the question next up on Slido here talks about when a Green Star building becomes dated. Now, you've got some experience here with retrofitting buildings.
Yeah.
You've got a portfolio of mixed ages. What are you doing to constantly refresh and keep your buildings energy efficient?
Yeah, I think that's a great question because that's something that at Argosy we're really focused on. The carbon footprint of demolishing a building is awful. And oftentimes what we see, if we just look around Auckland and Wellington, we can see that in many circumstances we've built a great building, but in order to do that, we've demolished something that was actually of really good quality. It was just past its date. I think we have to understand that when you create a green building, it's a journey. It's not a finished goal. You have to work on it all the time. If you drive a 1950s car, for instance, just try and tell me how many times you've had to upgrade and change things on the way through. The building's much the same. You have to keep working on it. You have to keep working on your life cycle. The building's going to last an awful lot longer than the air conditioning system and the lifting. So you have to keep working on the life cycle for the individual pieces on the way through there. As an industry, I still think we're pretty useless at reusing and repurposing existing assets.
And it's something we have to get better at very quickly if we want to reach these net carbon goals, right? We have to address that.
Fundamentally, yeah. And when you look at it from a seismic perspective, we've come through and we've said seismically this standard's not acceptable, and depending on where you are in the country, you've got X number of years to fix that. But we haven't said that about sustainability and green buildings.
Yeah. Richard, this is a question for a few of you, but I'm going to focus this to you, Richard. How big a factor in your RFPs is the sustainability of the tenderer? So when you're selecting someone to do work, a contractor or an architect or a project manager, how important is their sustainability rating in choosing who you partner with?
We're growing into that. So I would say several years ago, probably not on the radar for the business, but yes, certainly is now. And a question that we are putting to when we're looking to procure services and understand that. Again, moving to the Toitu and measuring the business, it's not just our buildings, it's going to actually our head office, it's going to our co-working business generator. So it's feeding through the business, and that's where that benefit will come from, is starting to look at the supply chain of our entire business and reduce it where we can. So that's something that we need to work on.
Kate, is there anything you want to add to that from a Westpac procurement point of view?
No, I mean, we're constantly looking, yeah. So our sustainability team and their procurement team, they're constantly looking at how we can improve and even retrofitting the buildings. I mean, working on the fit out and how to make that more energy efficient. Yeah, I mean, that's not part of my day-to-day roles. It's not part of my scope, but I know, they're focused on that.
I would add as well, between Auckland and Wellington, just consistent information from suppliers is not there. It's really hard to get a consistent approach, and very frustrating from whether it's council or whether it's someone who's taking your rubbish away. They're learning and they're struggling to keep up, I think, a little bit with the information requests that are coming from us.
I was going to say, I think we're actually seeing, as Bank has been asked to on RFPs to talk to our sustainability approach. The procurement team has done something a little bit in this area of trying to capture this on a yearly basis, and they do survey the supply chain or suppliers that they've engaged with sustainability questions, and that's really in an effort to sort of monitor those suppliers, not just on a RFP basis, but on an ongoing basis in terms of how their journey is going, and hopefully to try and encourage them to continue to improve as well.
The final question for you, and I'll get Peter to maybe address this to start, but feel free to chip in, guys. What has the impact of COVID-19 been around the overall demand from the sector towards sustainability? Has one element, a focus on health, been detrimental to a focus on sustainability or a benefit?
No, overall I'd say it was a benefit. Satish might be better to throw this one in, but I think it's probably fair to say that tenants have become far more focused on the quality of their air conditioning system. They've been far more focused on the way the building works and how healthy the building is in the first place. It's also given a benefit in terms of people having another look at the way their business is operating. How efficient is that? Are you allowing your staff to work from home or work remotely? What does that mean in terms of the building layout? And therefore it's creating an opportunity for still more development in that space.
And if I can touch on that, I mean, the impact, I mean, every day we're talking to our customers about sustainability strategy and sustainable finance. When COVID hit, I mean, understandably that dropped off for a short amount of time. But it wasn't that long. I think, it dropped off their radar, and financing was at the top of their radar and staying afloat for, 1 or 2 months. But then the conversation picked up very quickly, and it was surprisingly quickly, I think. They just went back to sustainability being, part of the normal day-to-day. Even following that now, it has just accelerated even further. I mean, that's just focusing on a green finance and sustainable debt kind of issuance and engagement perspective. And even when we look at the trends in that overseas, it was interesting. The sustainable debt market, went on hold for a bit during COVID, and then it accelerated with huge issuance in terms of social bonds and sustainability bonds as a mechanism to create funding to address and alleviate the impacts of COVID-19 and the pandemic. So it's picked up a lot quicker than we thought it would, and didn't completely drop off the mind of or the priority of a lot of companies, which was great.
Possibly the thing that we've got to ask ourselves coming out of COVID is, the mobilisation of governments everywhere to try and solve what is a big issue in a crisis. Have we got the same urgency to address the climate crisis, which is ahead of us? And I think the risk is that while there's a lot of momentum, we can't lose sight that we don't have a long time, and there's going to be no vaccine for this issue to come out. So, I think it's been helpful because it's shown just how quickly an event like that can impact on businesses and on the community and people's well-being. And it's probably been helpful, as Kate says, to continue that focus on overall sustainability.